So then we're just going to add our cost curves. Just a standard marginal cost curve, standard ATC curve, and I just kind of put this somewhere on the marginal cost curve where I know it's just going to have to hit the minimum. I just picked a point somewhere where I know this firm's going to make a profit. So then the profit maximizing rule for any firm is produce until marginal revenue equals marginal cost. So now we're looking at marginal revenue. So this firm's deciding where do I want to set my price, and therefore how much quantity am I going to produce. Well, I'm going to look at, does that next unit bring in more revenue than it costs me to produce that next unit, right? Marginal revenue, marginal cost. As long as marginal revenue is above marginal cost, I keep going. So that's how I decide my quantity, right? I go to that point, get my quantity, and then given that quantity, the demand curve tells me what price can I charge, right? Given that I just made that calculation, the highest price I can set and still sell Q1 is this price P1. So I'm going up to my demand curve to set the price. And so this is now the monopoly's profit maximizing quantity and price. And then we just need to get profit. So profit is just the difference between price and ATC for per unit profit. So that's going to be this, right? And that's going to be my profit. So this particular monopoly is making a profit, and we have deadweight loss because in terms of surplus, we have this demand curve, which is what people are willing to pay for this product, the marginal benefit that people get from one more unit of this output. Is still greater than the marginal cost of producing that output. But because the monopoly is profit maximizing, doesn't care about efficiency. It's looking at its marginal revenue curve, because remember, we're setting a single price, and if that monopoly, even though someone's willing to pay more than marginal cost, if this is going to be a single price monopoly, it doesn't want to produce that unit, because if I have to produce that unit, I have to drop the price on all my units, which means the extra revenue is actually down here, right? So it would be efficient for this monopoly to keep producing, but a monopoly is not trying to maximize efficiency, it's trying to maximize profit. So for the monopoly to go past there, if it's going to be setting a single price, its extra revenue is down here and the marginal cost is here for the next unit, so it doesn't want to produce. So even though someone was willing to pay more than that marginal cost of production, there's no way for that monopoly to produce that and still set a single price for all its output and to maximize profit. It'd be reducing its profit if it kept going. So that's why it's inefficient, and that's why we're creating this deadweight loss, because there is this sort of potential surplus here that's not happening. This monopoly produces less than the efficient amount of output, which means this is the efficient point, right? So as long as that marginal benefit or willingness to pay or demand curve is above marginal cost, it would be efficient to keep going. And so right where that marginal cost hits there, in other words, right where price equals marginal cost, because price is coming from the demand curve, and so if price is greater than marginal cost, which is what we have here at the profit maximizing point, right? Here's your price, here's your marginal cost. So the fact that price is greater than marginal cost means that it's inefficient, right? If it were to keep going. So remember, in a perfectly competitive firm, price was equal to marginal cost. So a perfectly competitive firm was producing the efficient amount. Monopoly doesn't. It produces where price is greater than marginal cost, which means it's creating a deadweight loss. So right here where price equals marginal cost would be efficient. Another point we might want to recognize here, so there's a couple different points that a question might ask you about, is we've already seen why this is the case. So this would be the maximum revenue point. So a firm normally doesn't want to maximize revenue, but just for the sake of understanding the graph, if it did want to maximize revenue, it would keep going as long as that marginal revenue was still positive, which meant, remember, that total revenue curve is rising here and then falling past that point. So as long as total revenue is still rising, marginal revenue is still positive, then revenue is still going up. So until that point, when marginal revenue equals 0, you've maximized revenue. set that quantity here, the price would be up here. So if for some reason this firm was going to be revenue maximizing, that's what it would do. The other possible point that we might want to look at is the break-even point. So again, firm's not going to want to go there if it doesn't have to, but that's where price equals ATC, and that means zero profit. Right? So as long as the difference between price and ATC, this firm is still making a profit. So this firm will still make a profit at the efficient point. It's just not going to be profit maximizing, right? So if I decided to be efficient for some reason, then I would still make a profit. It just wouldn't be profit maximizing. This is my maximum profit. Here is break evens, right? So I can keep going until there's zero profit at that break even point. Let me just point out, I drew this ATC curve here. It didn't necessarily have to be at that point just to show a firm making a profit. You could have just as easily put it down here. So as long as I cross, that marginal cost crosses at the minimum, this would still be a perfectly fine way of drawing a monopoly. I just usually draw it here just because I have a little more room to just stick the curve in there. But this would just be a monopoly with a lower fixed cost, for example, and just had a lower ATC curve relative to marginal cost, and so you would still have price, ATC, that gives you profit. Right, I'm still going to this point, marginal revenue because marginal cost, get my quantity, up to my demand curve for my price, and price down to ATC gives me profit. So one thing that can happen is if you change your fixed costs, or for example, a government gives you a lump sum subsidy, in this case, government just gives you money, or government taxes you on a lump sum basis, that would be shifting your ATC curve. So that's one thing that could shift it. And then if it was a per unit tax or a per unit subsidy, it would shift both marginal cost and ATC. And then you would have a different profit maximizing point. So if I tax this firm, for example, put a per unit tax, then marginal cost would be shifting up. It would cross over here somewhere, and I would have a new profit maximizing point. And notice if that ATC curve was high enough, so if we had high enough fixed cost pushing that ATC all the way up here, once it's above that demand curve, I'm going to have a loss because I'm going to still look at, okay, the best I can do is to produce at that profit maximizing point, and set the price here, but there's no way I can make a profit because ATC is going to be above that. So difference between price and ATC is my profit or loss. That's my per unit loss. That would be my total loss. And so this monopoly cannot make a profit given where demand is and given where ATC is. So let me just point out that a monopoly doesn't actually have a supply curve. So remember what a supply curve is. You give me a price and I'll tell you the quantity supplied. So for a perfectly competitive firm, that part of the marginal cost curve that we saw above ABC was the firm supply curve, because if you gave me a price, I just go over to marginal cost and that will tell me what the quantity supplied is. That's not the case for a monopoly. So it has a marginal cost curve, but it's not the firm supply curve, because remember how we got our profit maximizing quantity? We went to here, right? So it's not that you give me a price, I go over to marginal cost, right? That's not how we determine the quantity. So that marginal cost curve is not a supply curve, right? Remember, a monopoly is just setting a price based on marginal revenue and marginal cost. And remember, marginal revenue comes from demand. I just derived that from this particular demand curve. So if demand was different, that marginal revenue curve would be different, and you'd have a different price and quantity. So it's not a function of price the way that a perfectly competitive firm's supply curve was. So for example, if we shift demand, so if you can make it out, I left the old demand curve here and marginal revenue curve, but now I shifted demand and marginal revenue goes with it, because marginal revenue is just derived from that particular demand curve. So I shifted both demand and marginal revenue, and that gives us a new profit maximizing point and a new price, as opposed to the old one, which is down here, right? So at that old demand curve and marginal revenue curve, I'd be here, and my price, I'd be going to the old demand curve over here. And so it depends on demand, right? That wasn't the case for perfect competition. It was just my marginal curve tells me, you give me the price, which I'm a price taker, Marginal cost told me where to produce. That wasn't the case here. So it's dependent on what's happening with demand.